Good evening from New York. It's 5:54 p.m. on Wednesday, April 8th, 2026. Welcome to the Lynx Data Insight market briefing. The U.S. stock market is now closed for the day. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. We just witnessed one of the sharpest single-day relief rallies this year, so let's get right into the numbers.
And what a session it was. The S&P 500 closed at 6783, up 2.52%. The Nasdaq surged 2.82% to 22,638. The Dow ripped higher by 2.86%, adding over 1,300 points to close at 47,915. The Russell 2000 led the charge, up 2.97% to 2620. Breadth was broadly positive, 328 advancers versus 184 decliners. The VIX dropped to 2104, which is notable because it peaked above 31 just 12 days ago. The 10-year yield settled at 4.29%, the 2-year at 3.60, giving us a yield curve spread of 69 basis points, a normal, positively sloped curve. This is a classic geopolitical relief rally with an overlay of Fed minutes and AI corporate developments, and the primary driver is unmistakable, the 2-week ceasefire between the U.S. and Iran.
Let's unpack the ceasefire because there's a massive credibility gap between what the market priced today and what's actually happening on the ground.
Exactly right. The ceasefire announcement came just before Trump's 8 p.m. Eastern deadline on Tuesday. He agreed to suspend attacks on Iran for 2 weeks, contingent on Iran allowing complete, immediate, and safe opening of the Strait of Hormuz. Iranian Foreign Minister Arakchi accepted, but with a critical caveat. Safe passage would require coordination with Iran's armed forces and consideration of what he called technical limitations. According to CNBC, West Texas Intermediate crude fell more than 16% to close at $94.41 per barrel, its biggest single-day decline since April 2020. Brent settled at $94.75, down about 13%. But here's the crucial disconnect. Ship traffic through the strait has not picked up beyond the slow trickle observed during most of the war, according to Klepper data. And within hours, Iran's parliamentary speaker Galipov accused the U.S. of violating 3 clauses of the ceasefire: Israel's continued strikes in Lebanon, a drone entering Iranian airspace, and denial of Iran's right to uranium enrichment. An account linked to Galipov signaled the possibility of canceling the Islamabad negotiations scheduled for Saturday was serious. So the market gave this deal full benefit of the doubt, yet the deal's counterparty is already threatening to walk away.
And even if the ceasefire holds perfectly, there's the physical reality of restarting Middle East production.
This is the structural constraint the market is underpricing. Wood Mackenzie said on Wednesday that roughly 11 million barrels per day have been shut in during the war's first 5 weeks. Even if shipping bottlenecks clear, which itself could take weeks, producers face 6 to 9 month timelines to restart wellhead production. Qatar Energy's Ras Laffan LNG terminal, which produces about a fifth of the world's liquefied natural gas, needs roughly 4 months of repairs, and they won't even begin those without confidence in lasting stability. Meanwhile, Exxon disclosed that its Middle East oil equivalent production dropped 6% quarter over quarter, and it's increasing Permian output to 1.8 million barrels per day to compensate. So oil at $94 is still 35% above the roughly $70 pre-war level, and the physical supply pathway to normalization is measured in quarters, not weeks.
Let's layer in the Fed. The March minutes dropped today. What did they actually change about the rate path?
The FOMC voted 11-1 to hold at 3.50 to 3.75%, and the consensus still anticipates 1 cut this year, unchanged from December. But the minutes revealed a genuine split within the committee. Most participants saw the Iran war as potentially requiring easier policy if oil prices erode purchasing power and destabilize what is already a fragile labor market. The minutes specifically noted that job creation has been concentrated almost exclusively in healthcare, making employment conditions vulnerable to adverse shocks. But some members flagged the opposite risk, that sustained oil-driven inflation could require hikes. Now look at how the market is pricing this. The two-year yield at 3.60 tells you the market expects the Fed to stay on hold for several more months. The ceasefire nudged rate cut odds up to about 43% for year-end, according to CME Fed Watch. But here's the important nuance. Oil at $95 versus roughly $70 pre-war still means elevated headline inflation. According to GasBuddy, the national average for gasoline is $4.16, up from $3 before the conflict. The Fed typically looks through energy shocks if they're transitory, but inflation has now been above the 2% target for 5 years, as Vice Chair Jefferson explicitly noted this week. So the ceasefire gives the Fed breathing room to maintain its hold, but it doesn't unlock cuts unless oil falls substantially further, probably back below 80, and core inflation cooperates. The 10-year at 4.29 with a 69 basis point spread to the 2-year signals the bond market sees growth slowing. GDP was just 0.7% in the fourth quarter of 2025, but not enough to force the Fed's hand imminently. One cut in the second half remains the base case, contingent entirely on the oil trajectory.
That growth number is striking, 0.7%. Against that backdrop, who are the clear winners and losers from today?
Start with the cyclical winners. CF Industries led the S&P 500 gainers, up 10.56%. Dow surged 7.29%. Both are basic materials names benefiting from the reshoring thesis. U.S. chemical production is ramping up to substitute for offline Middle East output, and Citi on Wednesday upgraded Clean Harbors specifically on that theme. Intel popped 6.69% on joining Elon Musk's $20 billion Terafab joint venture with xAI, SpaceX, and Tesla to fabricate ultra-high-performance AI chips at scale. Intel is now up 60% year-to-date. Baker Hughes gained 5.41%, and Diamondback Energy rose 5.26%, both positioned for the months-long Middle East production restart cycle. SBA Communications, a tower REIT, climbed 6.87% on falling rate expectations, and Monolithic Power Systems hit all-time highs, up 5.91% on relentless AI compute demand. But the structural picture is even more revealing. Utilities have 87.1% of stocks above their 50-day moving average and 77% near highs, with 0% near lows. That's the strongest positioning of any sector, reflecting both defensive demand and rate cut optionality. Energy shows 86% above the 50-day and 0% near lows, which is remarkable given today's massive oil sell-off. The war premium has built such a cushion that even a 16% oil crash didn't break any energy names. Basic materials at 70% above the 50-day, with 0 stocks near lows, completes the strength picture.
And the losers? Because this rally had some sharp divergences that investors need to understand.
The losers tell you this wasn't a mindless risk-on day. AppLovin dropped 11.13%, Palantir fell 9.02%, Workday lost 7.86%, ServiceNow declined 6.94%. That's 4 technology names in the top 10 losers. This is a rotation out of high-multiple software and defense-adjacent tech into cyclicals and value. Coinbase fell 6.9% and Robinhood dropped 6.66%, even as Bitcoin rallied 4.4% to $71,733. That crypto equity divergence signals profit-taking in speculative platforms rather than crypto bearishness. And then there's Tesla, down 5.65% on a day the broad market screamed higher. First quarter deliveries missed at 358,000 versus 365,000 expected. The stock closed at 343.24, which is 14% below both its 50-day and 200-day moving averages, both sitting near 398. Tesla is down 21.64% year-to-date, with a 5-day return of negative 9.97%. JP Morgan reiterated its underweight, warning of a potential 60% drawdown. This is company-specific deterioration, layered on top of brand damage and margin compression. It's not a geopolitical trade. Structurally, consumer defensive has the highest percentage near lows of any sector, at 22%, and Constellation Brands crystallized why. They withdrew their fiscal 2028 guidance, citing subdued demand and deliberate consumer spending. Consumer cyclical shows only 26% above the 50-day average, with just 38% above the 200-day, the weakest breadth among major sectors. And technology is deeply bifurcated. The small-cap tech ETF hit all-time highs today, while mega-cap laggards like Microsoft, down 20.67% year-to-date at 374.33, drag the sector's breadth to under 48% above the 50-day, with nearly 20% of tech stocks near lows.
Wait, Microsoft down over 20% year-to-date while small-cap tech hits records? That's a structural divergence worth unpacking.
It's one of the most important signals in this market. Microsoft closed at 374.30, actually down 2.77% today on a massive up day for equities. It's trading 26% below its 200-day moving average of 474. Meanwhile, the Invesco Small Cap Technology ETF surged to fresh all-time highs today. 13 S&P 500 stocks hit all-time records, names like Dell, Jabil, Monolithic Power Systems, Seagate, Western Digital, Keysight, and Equinix. The Philadelphia Semiconductor Index hit its first record since late February. This tells you the AI infrastructure build-out and industrial capex story is alive and well in the mid and small cap space, while mega-cap names carrying high multiples and decelerating growth trajectories are being left behind. If you're only watching the Magnificent Seven, you're looking at the wrong tech market.
Let's talk about Meta's AI move today and the OpenAI IPO development, because both connect to the CapEx thesis.
Meta debuted Muse Spark, the first model from Meta Superintelligence Labs, after the $14.3 billion Scale AI deal. The stock closed at $612.69, up 1.15% at the close, though it was up nearly 9% intraday before the Galiboth headlines trimmed the rally. Meta is guiding $115 to $135 billion in AI capital expenditures for 2026, nearly double last year. Separately, OpenAI's CFO confirmed retail IPO share allocation after the company closed a record-breaking $122 billion funding round at an $852 billion valuation. OpenAI plans to spend $600 billion over 5 years on semiconductors and data centers. These are the demand signals that explain why companies like Intel, Monolithic Power, and the storage names are hitting records. The AI infrastructure build-out is the single biggest private sector capital allocation story in history, and it's providing a structural floor under hardware and industrial tech names regardless of the geopolitical cycle.
So what's the risk case investors should be stress testing here?
Let me frame 3 scenarios with explicit probabilities. Our base case, at 55% probability, is that ceasefire holds through Islamabad talks this weekend, but produces only incremental progress, no verified straight reopening, no significant tanker normalization, continued low-level violations and rhetoric from both sides. In this scenario, the S&P trades in a range of 6,650 to 6,900 over the next week. The 10-year oscillates between 415 and 440. Oil stays in an $88 to $100 band on WTI. The Fed holds through June, with one cut likely in the second half of 2026, contingent on the oil trajectory and inflation data. This is a grind higher with volatility environment. The risk case, at 30% probability, is a ceasefire collapse before or during the Islamabad negotiations, triggered by Iran formally withdrawing over Israel's Lebanon operations, or a resumption of Strait of Hormuz blockade activity. In that scenario, oil could spike back to 115 or higher on WTI. The 10-year could push to 455 on reignited inflation expectations, and the S&P could retrace to 6350, roughly a 6.5% drawdown from here. The sectors that led today's rally, travel, semiconductors, industrials, would be the hardest hit in the reversal. The upside tail, at 15% probability, requires the Islamabad talks to produce a substantive framework by mid-April, verified straight reopening with international naval escort, partial sanctions relief, and a credible nuclear enrichment freeze. That would compress the oil war premium by $25 to $30 a barrel, sharply lower inflation expectations, potentially unlock a Fed cut by summer, and drive the S&P towards 7,100. The energy importing emerging markets that surged today, South Korea was up 6.8%, would be the clearest beneficiaries of that scenario.
So, what's highest conviction for investors in this environment?
Highest conviction, U.S. chemical and materials producers like CF Industries and Dow Incorporated immediately increase exposure. The Middle East production gap is structural, lasting months regardless of ceasefire outcome, and U.S. substitution production is ramping. Secondary conviction, oil field services names like Baker Hughes maintain and gradually increase. They're positioned for the months-long restart cycle and elevated global capex. Tactically, semiconductor and AI infrastructure names that hit new highs today, the storage and power management plays, should be held structurally, as the $600 billion AI build-out provides durable demand. Hedge the portfolio with put spreads on the Nasdaq if the VIX pulls back toward 18. The geopolitical optionality is underpriced after today's relief. Avoid list high multiple enterprise SaaS, Workday, ServiceNow, until the rotation completes. Avoid Tesla until deliveries stabilize and the stock reclaims its 200-day average, and reduce exposure to consumer discretionary broadly. The breadth data is terrible, with only 26% of the sector above its 50-day average, and gasoline at $4.16 per gallon nationally is eroding household purchasing power in real time.
So, how does it all fit together?
When you step back, this is really about whether a geopolitical pause can become a geopolitical resolution before the economic damage from 5 weeks of the largest crude supply disruption in history becomes self-reinforcing. Today's rally priced hope, but the physical constraints are unforgiving. Wood Mackenzie's 6 to 9 month restart timeline, Rystad's $25 billion infrastructure damage estimate, and the fact that straight traffic hasn't normalized at all means oil stays well above pre-war levels for quarters, not weeks. That keeps headline inflation elevated, constrains the Fed, and creates a two-track market. AI infrastructure and U.S. industrial substitution production are structural winners, while the consumer is increasingly squeezed and high multiple growth names are losing institutional sponsorship to value and cyclical plays. The alternative case, and it's genuine, is that Evercore ISI's assessment proves correct, and this ceasefire extends for weeks to months. Trump declares victory, and the gradual normalization of oil flows drives a sustained compression of the risk premium. The Dallas Fed's own research published today suggested inflation expectations could improve quickly if the strait reopens. If that path materializes, the broad market rally has significant room to run, and today's 2.5% gain is just the appetizer.
Give us the 3 takeaways.
1. The risk. Saturday's Islamabad negotiations are the single highest impact binary event for global markets this week. If Ghalibab's wet delegation walks, oil reverses course violently, and the travel and industrial names that led today give back their gains plus more. Position sizing should reflect that weekend risk. 2. The market insight. The technology sector is experiencing its most significant internal rotation in years. Small-cap tech is hitting all-time highs, while Microsoft trades 21% below its 200-day average. The breadth data confirms it. Nearly 20% of tech stocks are near lows, while 26% are near highs. The profitable trade is in the infrastructure build-out names, not the mega-cap laggards. 3. The positioning idea. U.S. basic materials is the highest conviction sector in this environment. 70% above the 50-day average, 0% near lows, and a structural demand catalyst from Middle East chemical production substitution that persists regardless of ceasefire outcome. CF Industries, Dow Incorporated, and the cleanup plays like Clean Harbors offer the most favorable risk-reward into the rest of the second quarter.